Everyone loves the idea of unlocking cash from their building until they realize it's not monopoly money. A sale-leaseback can look like free money. Sell your building, stay as a tenant, and pocket that fat check. Yet, before you grab that pen, you need to understand the numbers and the trade-off. What looks like a win today can quietly cost you tomorrow. Let's break down the real math behind a typical sale-leaseback. Picture this. You own a 20,000 square foot industrial building in Burlington. It's about 30 years old, 18-foot clear, 3 truck-level doors, 1 drive-in, and 15% office space. It really needs a new roof and parking lot replacement within the next 3 to 5 years. Solid and functional, not flashy. Market sale price is $375 per square foot, or $7.5 million. As a side note, a vacant sale would sell for more. Investors buy based on cap rate. Owner-users buy based on price per square foot. Translation, users pay more than investors will for this type of asset. Now for the lease rate. Market rate is roughly $16.50 net. Again, in this scenario, you negotiate a tighter deal at $15 net. From the buyer's side, it's a stable yield. I explained the buyer's perspective further in another video. From your side, you just freed up millions without packing a single box. So let's look at the advantages. Instant liquidity. With the sale, you unlock $7.5 million that was sitting idle in bricks and mortar. That cash can pay down debt, fund expansion, or invest in equipment. Tax and balance sheet strategy. A sale can clean up your ratios, finance growth, or be time to manage capital gains. This is where your accountant shines. Operational control without ownership headaches. You sign a long-term lease, usually 10 to 15 years, and keep running your business exactly where it is, minus the maintenance calls. Deferred CapEx. Your roof and HVAC are nearing end of life, and that parking lot is one more winter away from crumbling. Those repairs could run $600,000 to $700,000. After the sale, well, that cost is no longer yours. Liquidity in the bank plus no looming repairs equals freedom to focus on what actually drives revenue. The path is always in the math, so here is the rental math. Starting at $15 net with 2% annual escalations, by the end of year 10, you would be at $17.92 net, which arguably would be below market rent. Over the 10-year term, you will have paid about $3.25 million in base rent. Those escalations are inflation protection for the investor and how you negotiate a more attractive lease rate, as well as a stronger sale price at the beginning of these negotiations. For you, it's manageable rent growth that should be cheaper than funding a new roof or HVAC yourself. Conversely, you lose the asset. That $7.5 million check feels great until you remember you'll be paying $300,000 plus year over year in net rent and won't be building equity again. Future appreciation. Historically, industrial building values in Burlington climb about 2% a year. At this rate, the property could increase in value by almost $2 million over the next 10 years. Lease obligations. You're now a tenant with renewal risk and less flexibility if your space needs change, such as expansion or relocation. A sale-leaseback trades long-term ownership for short-term liquidity. It's not wrong, it just has to fit your overall strategy. Well, what is it? The smart move or the short-term fix? It's a smart move if you need capital to grow, consolidate debt, or step away from costly maintenance. And it's a short-term fix if you don't have a plan for the cash or can't stomach losing long-term appreciation. The question isn't, should you do a sale-leaseback? It's when and how to structure it so you win both today and tomorrow. I'm That Commercial Realtor, and if you're sitting on an older industrial property and wondering whether a sale-leaseback makes sense, let's run your real numbers before you make a move. Because in commercial real estate, data talks and emotion costs. If you found this breakdown helpful, hit subscribe and follow for more no BS insights that make your money and your buildings work smarter.